So, beginner's guide to options. We've looked at call options. We've looked at put options. We've looked at the whole spectrum of putting them together. And now, today, we're looking at one of your favorite words, moneyness. That's right, so beginner options trading. Lesson number 4, we're looking at moneyness. Now, in the options universe, the term moneyness refers to the relationship between the current price of the underlying, right, the stock price, where it's trading, and the strike price of the option that you are trading. So as a reminder, the strike price is the price at which the option holder can buy for a call option or sell for a put option, the underlying asset, at some point in the future. Moneyness is typically categorized in 3 different ways: in the money, at the money, or out of the money. Right? Now that's based on the intrinsic and extrinsic value, which we did in lesson number 3. So if you're wondering what's intrinsic, what's extrinsic, then go back to lesson number 3, and that's a real good guide. We went through everything on intrinsic and extrinsic value, and we did that with the head of vol options here. Now, if it's in the money, you have intrinsic value. If it's at the money, it's almost there, right? It's almost there. You're on the precipice of having intrinsic value. If it's out of the money, then you don't have any intrinsic, you've only got extrinsic value, right? Easy to remember. Out of the money, no intrinsic. Now, on put options, if it's in the money, the stock price is below the strike price, okay? So if you're in the money, the stock price, your underlying, has gone below your strike price. For example, a long put with a $60 strike is in the money if the stock trades at 50 bucks, right? If it trades at 59.50, it is in the money because it allows you to sell at 60, right? So you've got that profit. Now, with any option premium above $10 being extrinsic value, right? Just to get that across. So if your strike price is at 60 and the underlying is trading at 50, that is $10 in the money. The option value, if it's anything more than 10, which it will be because there'll be a little time value in there, etc. If it's anything more than 10, that extra bit is extrinsic value. Now, a short put with a $40 strike is out of the money when the stock's at 50, right? So you're short the puts at $40. That reminder, that is you are prepared to buy the stock at 40. That's out of the money if the stock is at 50 bucks, as there's no intrinsic value in it. The premium is entirely extrinsic. If the stock stays above 40 at expiration, you collect all that premium, right? You're receiving premium. So that's different. That's if you're shorting puts, if you're selling options to collect premium. Now, for a call option, it's the reverse. If it's in the money, the stock price is above the strike price, right? So the underlying price is above your strike price. For instance, a long call with a $35 strike is in the money if the stock trades at 50 bucks, right? You've done really well. It's way above that strike price, allowing a purchase at $35. So if it's a $35 strike, you have the right, but not the obligation, to buy it at $35. Any option above $15, of course, any option value above $15 is extrinsic because you're $15 in the money. Now, a short call with a $60 strike is out of the money if the stock is at 50, right? So you've said, I am prepared to sell the stock at $60 and it's trading at 50. So there's no intrinsic value there. The premium is entirely extrinsic. So that's like me on Palantir at the moment, right? I'm short the $135. So that's all extrinsic value because the stock dropped away to, what, 110 overnight. If the stock remains below $60 at expiration, you collect that premium. That's all yours. Now, the three types of moneyness: in the money, out the money, at the money. The definition of an at the money option is slightly less rigid, right? It's a little bit, when you talk about at the money, it's like, okay, it's like when you're going to be there to meet somebody, right? Yeah, I'll see you at 3 p.m. All right, you might see them at 2:58 or 3:02, but you're still pretty much on time. In general, an at-the-money options are ones where the current market price of the underlying asset is very close to or equal to the strike price. Right? It's close. If it's trading at $299.80, you're at the money, really, on a $300 strike. This means at the money may not have a high intrinsic value, but it may be rich in so-called time value, right? The stock price is almost at your level, it's at the money, but the premium, the option value is high because it's got all that time value in it. Generally, long option holders benefit when options go in the money, while short sellers benefit when options stay out of the money, right? When you're selling options, normally you're going to sell them quite far away from the price, quite far away from at the money. So you don't want it to go anywhere near your strike level. That's when you start to sweat. That's when you start to get nervous. That's where I am in Deckers at the moment, because I'm short the $150 calls because I believe in Hoka. And I put that on when the stock was 158 and it's now 153, and I'm starting to think, oh, it's getting close. So out of the money options are in black on the Tasty platform. In the money options are in grey, and it's got a big ITM beside it. At the money options are the yellow line, right? So there's a yellow line where the at the money currently is, so where the stock price is. Now, why is moneyness important? Well, moneyness is an essential in options trading, shaping how options are used in your strategies. It indicates an option's risk and its reward, guiding decisions based on potential profitability. In the money options offer high premiums and greater profit potential, right? So if you sell an option in the money, you got to be pretty confident. So then you get rewarded for it because it's risky. While selling out of the money options have lower premiums, and if you're buying them, a higher risk of expiring worthless, a lower potential of profit, probability of profit. Understanding moneyness helps align strategies with risk tolerance and investment goals, making it crucial for strategic options use. Now, what are the takeaways? Well, in the money, out the money, at the money puts context around the strike price relative to the stock price. In the money options represent options that can be exercised, right? To exercise the option at expiry, you got to be in the money. Otherwise, it's a complete waste of time. Those options have real intrinsic value at expiration. Out of the money options represent options that would not be exercised. Those options would have no intrinsic value, right? If you've got a right to buy something at 150 and it's trading at 149, you're never going to exercise it on expiry. Being in the money is a good thing for long options, while being out the money is a good thing for being short options. That's a very basic, premise. Of course, there are times when it's not necessarily good being short options if you're still out of the money, if it's come a lot closer to being at the money. At the money options are just the closest options to the stock price, and they generally have the highest amount of extrinsic value due to the uncertainty of whether or not they're going to be in the money or out the money at expiration. So great, that is moneyness. So now we've done call options, put options, intrinsic versus extrinsic, and moneyness. So this continues our look at everything options.